Welcome, board members. Let's dive right in. Today, I'm stepping into the shoes of your Chief Strategy Officer to walk you through this explainer on what I honestly believe is the single most compelling M&A opportunity of the decade. We're talking about acquiring and completely turning around BluSmart. We're going to dig into the hard data, the core strategy, and the exact operational roadmap we need to take a company in total crisis and build it back into a market leader.
So, the big question. Can India's EV champion actually be saved? I mean, think about it. You build a company that boldly takes on absolute giants like Uber and Ola. You don't just survive. You pull in global investors, you become the undisputed electric vehicle success story in India. And then, poof. You watch it all crumble under financial controversy. The headlines flash, investors panic and pull out. It is a dramatic fall. But looking at this as your chief strategy officer, I don't see a tragedy here. I see a ridiculously rare, high-stakes opportunity for a strategic buyout. This is our chance to engineer a billion-dollar comeback.
Here's our game plan for today's explainer. We're going to hit the distressed asset opportunity, our acquisition and governance reset, how we'll structure the turnaround capital, our 5-phase operational comeback plan, which is really the meat of this presentation, and finally, how we build an unbeatable competitive advantage.
All right, Section 1, the distressed asset opportunity. Let's just go ahead and address the elephant in the room, the actual crisis that brought us to this point. How exactly does a celebrated EV champion morph into a distressed asset practically overnight? Well, it all boils down to partner governance. BluSmart's ecosystem partner, Gensol Engineering, got caught up in some serious allegations of fund diversion. And you know how this goes. The second promoters face regulatory heat, investor trust absolutely evaporates. Poof, gone. The fallout, a brutal 60% haircut to their valuation. Right now, competing buyout bids from folks like Eversource Capital are hovering between 850 and 1,200 crore rupees. The market is entirely pricing in the fear right now, not the underlying fundamentals.
And that right there is exactly why we need to strike now. Look at these numbers. Despite the absolute storm surrounding them, the underlying engine is completely intact. We're looking at a deployed fleet of over 8,500 EVs, a 70-core monthly revenue run rate, expected growth of 40 to 50%, and a highly established charging infrastructure. We are not buying a dead, broken-down business here. We're buying a fully functional, high-performance engine that honestly just needs a new driver and a completely clean dashboard.
Moving on to Section 2, acquisition and governance reset. Let's talk about how we actually secure this asset from competing bidders while making sure we mitigate those immediate, glaring risks. Step 1 is our acquisition offer. I'm proposing a bold, aggressive bid of 1,300 crore rupees. Now, yes, I know this outbids Eversource Capital's maximum offer, but why do it? Because you just don't win a premium customer base, a top-tier tech platform, and deep EV fleet expertise by digging around in the bargain bin. If we want the long-term strategic value of this platform, we have to secure it decisively.
But look, throwing capital at the problem won't fix it on its own. Step 2 is a complete top-to-bottom governance reset. This is our main contingency plan against all that ongoing market skepticism. First, we have to immediately strip out all controversial promoter influence. Cut it out completely. Then, we set up a brand new, strictly independent board stacked with respected leaders in mobility and finance. Finally, to really de-risk this deal, we don't do it alone. We build a consortium. We bring in climate funds, infrastructure investors, and EV manufacturers. This structure instantly restores public trust and injects massive industry expertise right into our DNA before we even try to grow operations.
All right, on to Section 3, structuring the turnaround capital. Let's get into the financials and figure out exactly how we fund this massive comeback without drowning the company in debt.
We are going to need a 2,000 crore rupee turnaround package. The mix here is incredibly intentional to keep financial stress to a minimum. 40% is equity, pulling in 800 crore from our climate and private equity partners. Another 30% comes from green bonds. That's 600 crore issued specifically for our EV expansion. 20% is covered through strategic partnerships with automakers, so 400 crore there. And finally, as a built-in contingency for some much-needed financial flexibility during those rough early turnaround months, we hold 10% or 200 crore in convertible debt. This specific mix guarantees we have the growth capital we need, but we maintain hardcore financial discipline.
Okay, Section 4, the 5-phase comeback plan. Asset secured, capital structured. Now we arrive at the absolute core of this explainer, the actual operational execution we need to pull off to reach profitability. Here it is, our 5-phase blueprint. This is exactly how we transition from a distressed, bleeding asset into a sustainable, highly profitable machine. Let's break this down phase by phase. Phase 1 covers the first 6 months, and the mandate is simple: stabilize. Our immediate operational focus to stop the bleeding is just pure hyper-efficiency. We have to restore customer confidence while fiercely optimizing our routes. By aggressively cutting down the number of idle vehicles, we crank up our overall fleet utilization. Seriously, if a car isn't moving, it is actively burning our cash. Now, our contingency here: if we don't hit our hyper-efficiency targets within 90 days, we instantly liquidate underperforming geographic zones to protect our cash runway. This kind of operational discipline is non-negotiable before we spend a single rupee on growth.
Once we're stable, we have to mitigate the massive risk of relying entirely on standard ride-hailing. Let's face it, that market is brutal. So phases 2 and 3 are all about diversification and expansion. We're going to launch corporate EV mobility, dedicated airport services, subscription models, and EV logistics. On top of that, we're expanding our charging network by turning our stations into standalone profit centers for third-party EV owners. Now, the main market risk here is slow B2B adoption. If those corporate contracts start lagging, our contingency plan kicks in. We immediately pivot those charging stations into aggressive, consumer-facing hubs to plug the revenue gap. The goal here is to ensure we aren't just another taxi app. We're building a resilient mobility ecosystem.
Moving right along to phase 4, AI-powered operations. Now, this is where it gets really interesting, because this is how we squeeze out maximum profitability. We're talking about deploying AI for demand prediction, dynamic pricing, and crucial fleet deployment. But the absolute secret weapon here: battery optimization. Think about this: a measly 2% increase in battery efficiency across an 8,500 vehicle fleet literally translates to millions in bottom-line savings. Every single percentage point directly increases our margins, it extends vehicle life, and maximizes how many trips we can do daily. Our operational contingency for this phase: if custom AI deployment hits tech roadblocks or delays, we immediately fall back to licensing off-the-shelf algorithmic routing, so there is absolutely zero disruption to our operations.
Finally, phase 5, national expansion. And note, we only pull this trigger after we've stabilized, diversified, and optimized the core engine with AI. We will strategically target the absolute fastest-growing EV markets: Bengaluru, Delhi NCR, Mumbai, Hyderabad, Pune, and Chennai. Expanding too fast, too early, that's a fatal risk. So our contingency plan here is strict, gated funding. Capital is only unlocked for a new city once our core engine in the previous city has locked in consecutive quarters of proven profitability. All right, bringing us to section 5, building competitive advantage. Let's see how this entire operational strategy builds out our ultimate defensive moat against the competition. You look at Uber, Ola, Rapido, they are completely locked in this relentless, cash-burning race to the bottom, competing on standard rides and slashed prices. My strategy for us: simple. Let them have the bottom. We are absolutely not engaging in a price war. Instead, BluSmart is going to compete on sustainability, a premium customer experience, unmatched reliability, and our own proprietary EV infrastructure. We are actively positioning BluSmart to be the Tesla of urban mobility.
Board members, a great vision alone isn't going to save a company. Governance matters. Capital discipline matters. But, distressed companies often create the single biggest opportunities. With our bold 1,300 crore rupee acquisition, a total governance reset, a structurally sound funding mix, and this strict contingency-backed 5-phase operational plan, BluSmart isn't just going to survive. It's going to become India's leading sustainable mobility platform. This mathematical, highly structured approach, it's exactly what guarantees our success.
So the real question here isn't whether BluSmart can be saved, it's whether we have the strategic discipline to actually execute this turnaround. I want to end this explainer by turning the boardroom over to all of you watching. What would you do if you were the chief strategy officer acquiring BluSmart? Would you tweak that 5-phase plan? Are there other market risks out there you'd prepare for? Drop your own turnaround strategies and thoughts down in the comments. I'd love to read them.